Hey guys, Scott Short here with Loan Depot. My MLS number is 225998. Got my good friend here. That way. That way.
Meagan Harris with Golden State Finance Authority.
Now, I love talking to Megan. She's the official trainer for Golden State Finance Authority for California. If you're outside California, it's called National Homebuyers Fund, and she also trains for them too. So the same product, but just different locality, correct?
Exactly. I mean, there are different products available nationally, but we are here to focus on the California version of the program.
Okay.
You guys know there are options regardless of where you're located.
Cool. So today we're talking to our friends who want to buy a house. So this is going to be our first time home buyers. You're buying a house, but let's kind of jump a little bit ahead. We'll come back. Do I have to be a first time home buyer to use your money?
No, which is fabulous, Scott. A lot of down payment assistance programs do require that the home buyer is a first-time home buyer, and that is not a requirement we have with any of our down payment assistance programs.
Boom, there you go. I like that. But there is something. Let's kind of dive a little bit deeper because you know me, I'm gonna dig in a little bit. So if everybody is a first-time home buyer, do they have somebody has to take home buyer education?
Yeah, so typically one of the common features of down payment assistance is the requirement to complete home buyer education or counseling. And so what GSFA has done is delegated that requirement to the agency. So what that means is if you're doing like a conventional loan or an FHA loan, you'll follow FHA's guidelines on whether or not you need home buyer education. And typically when you are applying for one of these programs, you'll have to get home buyer education done if all of the borrowers on the application are first-time home buyers. So in other words, if everybody's a first-time home buyer, then at least one person needs to complete home buyer education or counseling.
Boom, there you go. So that's why I want to talk about that conversation because we're talking about you don't have to be a first-time home buyer, but if you are all, to make sure we cover that. So good. So this time around, we're going to talk about your conventional loan. So it's called under the open door program. So you have multiple programs, but today we're talking about conventional open door. So let's start out with, there's a 30-year fixed rate term, right? And then right now until January 1, the loan limits are old loan limits. We're going to new loan limits. Can you break that down?
Yeah, so as of December 13, well, let me just back this up.
Thank you.
So the loan limits for the Golden State Finance Authority down payment assistance programs are based on the national conforming loan limit. And currently that national conforming loan limit is $548,250, but it is increasing on January 1st, 2022 to $647,200, which is a massive increase. We're really excited about that. What that means for the program is that we are also going to be following those max loan limits. So with respect to when it's effective, we're allowing on open doors conventional loans for reservations to be made as of January 1st under the new loan amount, but currently they can still make reservations under the $548,250.
Gotcha. So now also with people, we're talking consumers, so I'm trying to not get too deep in the weeds, keep me on track, that usually some loan programs have different loan limits as you change counties. But you guys are across California, no matter what it is, you go off either right now the 548,250. As of January 1st, you go up to 647,200. Is that correct?
Correct. And that's only applicable to our conventional loans because, as you know, Scott, with government loans, they can have a variation in loan limits depending on the county. So to your point, yes, for the conventional product in California, the max loan limit is the same regardless of the county.
Cool. And so this, just for clarification, that I'm trying to dig not too deep, but a little deep, is that you're saying that on those loan dollar figures maxes, it's going to be based off loan when they is it registration or lock date for them to which max will they have?
Yeah, so it is going to be based on lock date. So, which is more or less the same when you're making a reservation with the program. The lock date, the reservation date they're one and the same. And so that option is going to be available at the higher loan amount for open doors conventional borrowers on January 1st.
Cool, perfect. Because so for our consumers out there listening to conversation, lock date is basically when you lock your loan, and we ask your lender, your loan officer to say, lock that loan at that rate. I want that rate guaranteed for this, my loan. So when you say lock, we're saying we're guaranteeing the rate at that point. So make sure you talk to the loan officer about that piece. So cool. And then let's go down to, now here's the big thing. So the down payment assistance program. So now you have two kind of categories. You have one category is going to be if your income is less than 80% of the average, was it area median income, right? Or if you're
Correct.
above that. Can you break out that work, how that looks?
Yeah, so with the conventional open doors program, there's going to be different options available according to the borrower's income level. And that's where the differentiator between that 80% AMI comes into play. So just really quickly, for a conventional loan, we do have an income limit for the program, and it does vary by county, right? So you'll base the income limit, we have them posted on the website, where the county, where the property is located rather. So wherever the property is located, that county, that's the one you want to base your income limit on. And so when you pull up the income limit, Scott, it's going to tell you what the overall income limit is for the open doors conventional program. And then underneath that, it gives you the 80% AMI number. And so the reason you need those two numbers is because it makes a difference in what options are available to the borrower under the program. So for example, on a conventional loan, if your income is under the overall income limit, at or below the overall income limit, then you can use the program, right? If your income's over the income limit, then we can't do the program, right? But the income limits are very generous. For example, in Santa Clara County, the income limit is $267,200.
Wow.
And in Santa Clara, we need that, right?
Yeah.
Because of the cost of living there.
Yep.
But basically what you want to do is make sure you understand what income you're using to qualify for the loan, because that's going to differentiate what kind of credit score you need. So for example, if you're over 80% of the area median income, which is that second number we talked about, then you need a 680 FICO to qualify for conventional open doors. Whereas if you're at or below that 80% AMI number, then you only need a 620 FICO.
Wow. Okay.
So that's a big difference there. And it's just about what income you have on your loan application, not household income. So that's an important thing to note as well.
Can you kind of dive a little bit at household income versus income on the loan app? Can you break that down?
Definitely. So household income pretty much accounts for the income that you bring into the entire household, right? So all the adults living in the house and the income that is brought into the house. That's essentially household income. Whereas qualifying income is only the income you're using to qualify. So for example, if you have two people living in the house and both of them have jobs, then both of those incomes are considered household incomes, right? Whereas if we put only one borrower on the application, or even both borrowers on the application, but we're only using one job from that borrower, from one of the borrowers, then that's qualifying income, right? Because we're only considering the income that we're using to prove the borrower's ability to repay the mortgage. We're not considering the other borrower's income. So that's where it can differentiate between household and qualifying.
Cool. So when people out here listening and watching this, that when you hear that conversation, when the lenders ask you, says, you make too much together, but if one person does it by themselves, you qualify. That's the conversation we're talking about. So make sure you understand that piece. So they're not trying to trip you up or anything. It's just basically just how to work the program by the rules you guys put out. So that's cool. So then when it talks about the down payment amount, right? Like the max is 7%, but I think the 7% is only for the less than 80, right?
Correct. So you'll notice, in addition to the different credit score requirements on Open Doors Conventional for borrowers with that 80% AMI, there's also going to be a difference in the max available assistance to those borrowers as well. And so the max available under Open Doors Conventional and assistance is 7% of the total first mortgage loan amount. And so if you're at or below 80% AMI, then you have access to that full 7%. Whereas if you are over 80% AMI, but still at or below the overall income limit, then your options will be a little different. The assistance is typically less than the full 7%, but it's still fairly generous.
Right. So let's break it down a little tighter for our people. So if you're looking at a $300,000 loan amount, first loan amount, so 7% is going to be $21,000. So people understand that you said 7% is going to be off your loan amount. And that's what you figure out. That's going to be also for down payment and closing costs, usually for both, not for one, correct?
That is absolutely correct, Scott. And closing costs include a number of expenses. So, all the fees that you have associated with making your loan, your earnest money deposit, appraisal reports, credit report fees. These are all fees that can be used to help offset the expense to the home buyer.
Cool. So it's good. So this will also clarify for people may ask this question, but they're not here to ask it. So let's say if there's excess money, that cannot go back to the consumer unless they prepaid something. Like in our world, they're going to prepay for their appraisal. So I would assume that they can get that money back just for that one piece they prepaid for. We'd have to prove it to you guys that they did prepay. It's not, can you break it down for people how that kind of plays out?
Yeah, so the proof is in the CD, Scott, the closing disclosure. It shows what the borrower has paid outside of the closing transaction versus what's going to be paid out of escrow. And so in that situation, we have the borrower.
Thanks for the closing cost conversation. I appreciate that piece. So that's just a piece that the 7%, take a time your loan amount times 7% for this conversation. But one thing good with your program is you allow people to take less percent. Can you break it down? How, if you take, let's say if I only need 6%, how does that play with you guys?
Yeah, so you're not locked into taking the maximum available under the program. We have a range of options under conventional, specifically with Open Doors. We even have a 0% down payment assistance option, which basically allows a buyer who, maybe they don't need assistance, but they only have a 620 credit score, and they still deserve a really awesome interest rate on a 30-year fixed rate mortgage. And so that would be their opportunity to get a great interest rate, 30 years fixed, even though their credit isn't the best, but they have enough down payment and closing cost money saved on their own to where they don't need assistance from us. So basically the assistance ranges from 0% to 7% on Open Doors conventional. And as you mentioned, Scott, it can be used to reimburse the borrower for all of the expenses that they've paid up front to make the mortgage and close the loan, including their earnest money deposit. And then even if there's an excess after that, they can even pay down the principal balance on the first mortgage loan. So that kind of reduces the amount the borrower will pay in interest over time and the number of payments that they make. So it can all work out to the borrower's favor depending on how the funds are applied. It's really discretionary.
Cool. Okay. That's good. That's a good conversation. That's why I want to make sure you're doing somebody who understands the program and how it works. So let's dive a little bit deeper than 7% here. So 7% is not all 7%. So break it down because you have a piece is going to be gift and another piece is going to be a loan. How's that work?
That's a really important point you bring up, Scott. So the assistance is structured in a certain way. So a portion of the assistance will be a second mortgage, and that's going to be 3.5% of your total first mortgage loan amount. Okay. And so the second mortgage doesn't have any payments required. There's also no interest on it. And so there's no interest that accrues. It does have a 30-year term, and it'll be due and payable in full in 30 years or whenever the first mortgage is paid off. So if you pay off the first mortgage through selling the property or refinancing the loan, then at that point, that's when that second will be due and payable. And that, again, that's equal to 3.5% of your loan amount, interest-free, no payments. And then the other half, if we're taking the full 7% of assistance in that example, the other 3.5% will be a gift from the program. And the gift portion of the assistance provided is immediately forgiven and never has to be repaid at any point in time. So as soon as the escrow closes on the loan, the borrower can forget about the 3.5% assistance that was provided as a gift because it was just that, and we will not ask for it back.
Boom. So let's kind of break it back a little bit further. So let's say if I did a 6% only, so how would I break between the gift and the second loan? How's that look? If I do 6% only.
So if you're doing a 6% assistance on conventional Open Doors, 3.5% is going to be your deferred second,
Gotcha.
and 2.5% is going to be the gift. And so that's just one thing you want to keep in mind on conventional. The second is always going to be 3.5%.
That's right here. Yep.
And so anything above 3.5% assistance is what the gift portion will be.
Boom. See, that's what I want to hear. So thank you. So I started to dig down it low, but when I talk about consumers here watching this stuff, they need to know this stuff a little way more than we do. So I appreciate that. And then let's see, I'm flipping page here. So I told Megan I'm going off her guidelines because I didn't keep order because Megan has to keep me like a cat. Heard that cat in the place. So I appreciate her dealing with my craziness. So then, but the big thing we did mention a minute ago is with the second mortgage they have is that if you try to refinance your house, you got to pay that loan off. Can you explain that how it works?
Right. So even though you don't have to make any payments on the deferred second mortgage, it is not a gift and it does have to be repaid. So in the event that you go to refinance your mortgage, that second is going to be there and it will need to be paid off. So hopefully when you refinance, you have enough equity to include that second in the payoff for the first mortgage, because that's essentially what happens when you refinance. And just a quick, 101 on refinancing. Refinancing a loan is just simply taking the amount and potentially borrowing more or less at a different interest rate. And so whenever you do that, it pays off the previous financing that was in place. And in that case, it would be your mortgage, and that would mean your second mortgage would be due and payable. So I know that was kind of a long-winded.
That's good. That's good.
There,
That's
I
good.
just wanted to be clear.
Yep. And that's the key thing, because in the past, some lenders were able to keep that loan, but everybody's pretty much across the board that we know is that second loan's got to be paid off no matter what. The good thing on this loan is that, like you were saying earlier, I call it goes to sleep. It goes to sleep until sell the house, refinance, or 30 years go by, right? So when it's sleeping, can they make a payment if they wanted to, or how's that work?
There's really no benefit to the borrower making a payment because there's no interest on the loan. If they want to do it just for the peace of mind of knowing the balance is going down over time, we actually don't accept payments on the second. But what we can suggest is that that's money that they set aside, right? As if they were making a payment, so that whenever they have enough money, they know it's been taken care of, regardless of the timing of when they sell or refi or whatever. They know they have that money aside ready to pay off that second.
Perfect
But that's not
answer.
required. Typically, when people are ready to refinance, there's enough equity in the property to pay off that second. But it does depend on timing. And as we know, timing is everything, especially with real estate.
Right. So let's say this, for a consumer standpoint, if for some reason they're crazy enough, they go to another lender, not the lender got them in this beautiful loan, they went to some other lender, did not know they went to this program, how would they be able to tell their lender that they use a first-time homebuyer program to the lender they're refinancing through to make sure they know that second's got to be paid off?
Yeah, so sometimes a lot of time passes between the borrower getting the assistance and actually going to refinance. It could be 2, 3, 4 years later, and maybe they just forgot about it because the program is so easy to use. It's also easy to forget you even had a program in the first place, right?
Yep.
And so what that does is it positions people to leave out information unintentionally.
Right.
But when you go to refinance loans, you're working with the loan officer, they're going to pull a title report on the program, or on the property rather. And the title report will list all of the liens on the property, and the second lien from the assistance that was provided will appear there.
I got you.
And so even if the borrower forgets to mention the program to their new lender when they want to refinance, the lender will find out about it. But it's just best to kind of keep that in the front of your mind, so there's no surprises, and just let your new loan officer know, hey, when I bought the house, I got some assistance, and so there's a second mortgage on the property as well. It should be around this dollar amount, right?
Oh, perfect. So that's what I want to hear, because I don't go there, sorry. That could be a whole, that's a rabbit trap that Meagan will not let me go down. So we'll go back down to the occupancy. Occupancy means, when you get these loans, pretty much every lender, these loans are for owner-occupied only. This is going to be house you live in for your primary residence, not going to be some rental property. So, in your guys' guidelines, it says, you have to occupy the property within 60 days of close. Can you break that down? How it works?
Correct. So, sometimes when you buy a house, you need to make some improvements to it, or you have to have some loose ends at your other place or whatever, right? But bottom line is, when you use this program, the intention has to be that you will live in the property as your primary residence. That's the only way your property will be eligible for the program. So the deed of trust, which is the document that governs the mortgage against the property, is going to dictate that you move into the house and occupy it as a primary residence within 60 days of closing the loan, which is fairly easy. I closed escrow in September, and at the end of September moved in December.
Right.
So it happens. Sometimes you push the full 60 and no one's there, keeping a
tab.
watch on it.
Yeah.
But you still want to be compliant just to
Yeah.
make sure everything's on the up and up. And I do want to emphasize when we're talking about eligible properties, it does have to be owner occupied. We cannot do second homes, we can't do vacation, and we cannot do investment
I
properties.
don't know.
And we can do condos
But
for borrowers who are at or below 80% AMI.
yep.
And for every other borrower, you would just do your single family 1-unit property.
Got it. Boom. So cool. So that's the other thing I'm kind of leading into was that when people try to buy a house, a lot of times the price of houses are so crazy right now, which is like, oh my gosh, I mean, to afford a house, you know, it's sometimes need some outside help. So if I have someone like my mom, she wanted to co-sign for me that live in the house, how's that play out?
Yeah, so if your mom is trying to co-sign for you, we don't have any restrictions against that in the program, but we do defer to the loan agency on their requirements on that. And as of right now, FHA is the only agency that I'm aware of
Right.
that will allow that in this program. So for a Freddie Mac, which is our conventional option, I don't think that that would be available, but in any event, it would be their call, not ours.
Yep. Right. So that's what I'll make sure people understand that you can have a co-borrower who lives with you, it's okay. But if they don't live in the same house as you do and have their own payments and stuff or whatever, that's not so bueno with this program right now as it currently stands. So cool, good. And then, like you said, we're doing a single family only, a PUD. Can you explain what a PUD is?
A PUD is a planned unit development. It's kind of like, when you go to a neighborhood and all of those homes look the same.
Stamp.
Right. That's typically what a PUD's going to be. A PUD can also be a townhome. It's just basically when there's a development and a developer built the property or the project, and then, sold homes out of that project. So that's basically what a PUD is in a nutshell. And that that property type is also available for financing under Open Doors Conventional.
Right. And one thing
We
we
also
see,
do manufactured home. I want to point that out, Scott.
one time, what was that? I missed that. What you said?
Manufactured home
Yes.
on Open Doors,
Yep.
Unfortunately, is not a property type that we have available.
For conventional, okay, gotcha. So with the PUD stuff, and for the consumers that are listening, sometimes my lovely realtor people, I love them, just bless them, that sometimes they call a PUD a condo. And sometimes it looks like it, but they have to make sure, because in my lending world, it's a dramatically different product. And in your world, you're telling me, if you have if you have more than 80% AMI income on this program, we're not playing with condos, correct?
Correct. Yeah. So if your income's over 80% AMI and you're looking at a condo, it's really important to make the distinction. Find out what kind of property it is. Is it a PUD? Is it a townhome, or is it a condo? Right? Because that's going to be the differentiator as to whether or not you qualify for financing if your income is over 80% AMI, which again stands for area median income. And we have those figures posted on our website too.
Boom. Thank you. So that's one thing drives me batty, because there's a certain place here in Sacramento, they keep calling it a condo, going, it's never been a condo, it's always been a PUD. Here's here's legal description. Don't run me crazy, but my consumer friends, it's all good. It's all good. We bark about crazy stuff. It's all good. And then let's see, we're flipping page over to page 3. So everything else back here when we talk about. So that's page 1. Okay, sorry. So page 3 back here. We talk about 80% AMI. We got that stuff. So let's dig a little deeper. So on the 80%, so if your income's 80% or lower of the AMI for your area, you get a better interest rate. Remember, your program, you get lower mortgage insurance, and you get some of that. There's a couple of things you have. Can you break down what the benefits are if you have a less than 80% AMI income for the program?
Yeah. So there are a number of benefits aside from being able to finance a condo, which another distinction from a PUD is with the condo, you don't necessarily own the land that the building is on. But another benefit for conventional borrowers, 80% AMI or less, is that they only need a 620 FICO, right? That's the minimum score they need to qualify for the program. They get the full access to that 7% in assistance, and then they get the charter level mortgage insurance coverage, which reduces the max mortgage insurance requirement to 18%. And I know that's kind of a technical term. A lot of first-time home buyers aren't going to be familiar with mortgage insurance, but just know that's a typical expense when you're borrowing more than 80% of the value on your property. So those are just some of the highlighted benefits. The interest rates that they have available are also better
Right.
when your income is at or below 80% AMI. And just to kind of give people the heads up, the more assistance, even though we're not charging an interest rate on the second mortgage, right? We're not charging for the assistance per se. The more assistance is provided, the higher the interest rate will be on the first mortgage. So there is a relationship between the interest rate you'll pay on the first mortgage loan and the amount of assistance you receive. Okay, so really important that your loan officer is paying attention to how much money you actually need, right? Because if you get more assistance than you need, then you'll be paying a higher interest rate than you should be paying. So really important to kind of make sure those numbers line up so that you're not overpaying or you're not under assisted.
Right. That's where I want to go with that thing, because it's great that you're helping that class of people, which is it's not really, I don't, what do you the 80% less AMI, is that like, what's the reason for that? Do you know on that why we're looking at?
Yeah, so basically the 80% AMI tends to be the most needs-based population.
Gotcha.
Right. And so folks that are at or below that threshold typically need the most assistance because of the economic conditions that we're in, right? And so we want the overall objective of these programs is not only to create home ownership, but also to create affordable home ownership. And we already have a crisis with home prices and inventory. So the least we can do is make sure that the programs we have available to get borrowers into these homes are affordable when they get there.
Boom, that's one here. Thank you. Because that's always, some, people want to make sure that, there is, that certain group of people being helped up a lot more. And that's good. We appreciate it because we all need houses, right?
Exactly.
And then so we talk about this, we talk about that. And the good thing, let's kind of touch back a little bit on the mortgage insurance stuff. That I think the factor you were talking about, if you're above 80% AMI, right? What do you think is almost like double factor, or how much more do you think? I don't know.
So I think the standard coverage is 35%,
so it's almost double,
coverage, and then it drops to 18% at the max on that charter coverage. So that's like almost 50% different. That can make a huge difference in the monthly MI premium, and then again, by default, the overall housing expense.
Cool. Now, I think one thing I did forget, which shame on me, is what's the minimum down payment I got to put down on these properties?
So with conventional, your max loan to value is 97%. So the minimum down payment in that case is 3%.
Boom. And that's good. And don't freak out, people, when you see, because here's the loan amount, 3% down, right? But then we come with that second, recognize it's going to be, above, that's going to be over 100% loan. But you guys are okay up to a max of 105% combined loans. So don't freak out about that. It's just how it works in these programs. But the lender's okay. The lender understands this stuff. So you see, like, you go above, like, oh my God, I'm 103. Like, or in this case here, probably, you're more like, maybe like 100%. Because if you're 3% down, you got 3%, whatever. So math's going to work out. So don't freak out that piece, but let your launcher break it down for you and show you how it works out. But it's all good. And then anything else? I think we did pretty good on this one. I think we got through it pretty well. Is there anything I'm missing? Anything you can think of you talked to me about that maybe something we else need to kind of elaborate on for the conventional version?
I really think I just want to touch on really quickly. Some people kind of have like a twinge of skepticism or disappointment when they hear that the percentage is based off of your loan amount instead of your purchase price. And I just want to kind of reinforce the fact that that's not a bad thing, right? If your house is, $740,000, but you're only getting a $640,000 loan from us, you're still getting 7% of $647,000, right? Which is what? A very high number.
Exactly. I like it.
Somewhere in the neighborhood of $30,000-$40,000, right?
Right.
Right, higher. Okay.
Yep.
We're not math whizzes here, but what I will say is that these programs go a long way in closing the gap between what you have in your pocket and the price of the home. So don't let the any negative stigmas or rumors or assumptions about your situation or down payment programs in general deter you from getting the assistance that you need.
Cool. So, I wrap it up here. So we don't want your numbers because it's consumers. They have to talk to the lender about this piece. But if they go to your website, number one, what's the website address? Where can they find more information to help them in homeowners language, not my lender weird language, right?
Yeah, so to be fair, Scott, our website is designed to support lenders and realtors in using our program. So there's not going to be a lot of consumer-friendly information there, although we do have some videos, some resources and information that we invite consumers to visit and peruse. And so the website is www.gsfahome.org. And so if you go to that website and click on housing programs, and you underneath housing programs, you'll select Open Doors Down Payment Assistance, and that'll give you a summary of the program. We also have a list of participating lenders. There's a link there that you can click, and it'll give you a drop down of all the lenders that are authorized to use the Open Doors program.
Boom. And then for my consumer friends out there buying a house, if your lender doesn't understand this program or on the program, give them the website and tell them to go figure it out, because they can call Meagan at that point because they're a lender. That's who she works with. But totally appreciate your time as always. Your wealth of knowledge. You're just a ray of sunshine in my world. So I appreciate all you do for me. So we'll wrap this up for the conventional version. We'll come next time. We'll talk about the guppies.
Sounds good, Scott. Thank you so much. It's always a pleasure.
Oh, thank you.